Okay, yeah, not too hard. Great.
Mr.
Sorry
Pollard,
to
thank
make
you
a
for being here
dramatic
today.
Entrance.
Yeah.
People say a lot of times after they hear me speak, I didn't need to make a dramatic entrance.
Yeah.
I was already there. You want me to begin?
The floor is yours.
Great. I'll abbreviate a little bit to the chairs, vice chairs, and committee members. Good morning. It's a pleasure to be back in California. I'm glad to be here.
Can we make sure his mic is on? Can we make sure?
Am I speaking close enough? Okay, great. Fine. Okay, Doug. So, my name's Alfred Pollard. I'm the General Counsel for the Federal Housing Finance Agency. I've been dealing with PACE since 2009 when the Department of Energy called me up to talk about something called the PACE program. Our agency, as you know, oversees the federal home loan banks who don't actually buy loans. They get collateral pledged to them, and obviously we oversee Fannie Mae and Freddie Mac, who are the major players in purchasing loans and securitizing them. So to facilitate my comments, I'm really going to focus on them today. The enterprises are in federal conservatorships. They've received $187 billion in federal government support. I might say that means you and me as taxpayers, to maintain their operations. And that's been important. They've had good operations and helped a lot of people either refi or get a loan modification to help them stay in their homes. Today's hearing is about residential energy retrofit lending. In short, this means the financing for the product, not the product itself. While the product is timely and important, the financing method is at the core of your discussion today. Whether funded by a PACE loan or a second lien loan, the energy efficiency product is the same. Whether the financing method has significance for homeowners, communities, small lenders who keep loans in their portfolios, the banks, the enterprises, and those who own mortgage-backed securities, such as you'd find in a pension fund or a mutual fund that almost every homeowner may have. In 2009, 2010, we and the bank regulators, along with major financial trade groups, expressed concerns with the PACE model. We'd actually sent out a letter in 2009 to all the state organizations in Washington, NACO, the counties, League of Cities, all the various groups that are in Washington, alerting them that we just learned about this. They expressed concerns about this lending program. As conservator for the enterprises, FHFA has stated it cannot support first lien PACE programs for enterprise participation. I hope these remarks will actually assist you in understanding why that remains FHFA's policy. We support energy efficiency efforts by homeowners and home purchasers. And I have an attachment to my presentation that talks about what Fannie and Freddie and we have been doing in that regard. This topic is what method should be employed to finance retrofitting a home with energy-efficient products with a primary, I understand, but not exclusive focus on solar. PACE initiatives contemplate state legislation to authorize counties and municipalities to administer programs to finance homeowner retrofits. By working through the counties, PACE programs seek to secure a first lien position for their loans, as this would prove attractive to investors. With few exceptions, and there are several, Sonoma and others, Placer, counties and cities have undertaken these programs by engaging outside firms. The programs here in California and across the country in the PACE model principally look to the value of the property rather than the ability of the homeowner to sustainably repay the loan. That was what was mandated in the Dodd-Frank Wall Street Reform and Consumer Protection Act, or the Dodd-Frank Act. The focus on ability to repay, which, by the way, was no means a new concept for bankers, aimed to correct the asset-based lending that contributed to the financial crisis that began in 2007. Now, these programs, in addition to undertaking asset-based lending, counties and municipalities may charge up to 10% for administrative fees, and there are additional fees imposed by some of the administrators. These numbers are generally well beyond what a second lien mortgage would contemplate. Total authorized amounts for loans vary by states across the country, 10% and up. I would tell you the stated consumer protections are narrow. They're generally limited, and this was stated in the initial law here in California, that a borrower is not filed for bankruptcy, that they're not behind on a mortgage, or been delinquent on property taxes. I would tell you, and very much, that's sort of a backward-looking thing that an investor would care about and a lender would care about. But there's not a lot more about what a homeowner would care about. Beyond that, it's been up to localities to determine what protections to afford consumers. Even where those protections exist, they are not uniform, and they have no enforcing agency behind them. And I might add, we're 7 years into a program and continuing to see people making improvements. It's a little unusual to roll out a program where loans can be made up to $250,000, and the protections are coming after the programs are out. So what about our agency and PACE? Because of the transfer of risk to the enterprises and the banks by PACE programs through the first lien status, FHFA has made clear that the banks should undertake actions they deem appropriate to protect the collateral they acquire, and that Fannie and Freddie Mac should neither purchase nor refinance mortgages with PACE loans attached. While the enterprises have additional authorities to protect their first lien status, FHFA has directed only these actions to date. PACE lien is referred to as a super lien as it moves ahead or primes a first mortgage lien. A PACE lien often represents a retroactive creation of liability on a property ahead of the existing first lien mortgage, which the mortgage holder neither knows about nor consents to. I digress to note that most commercial PACE programs for buildings require consent of the lender. The creation of a super lien thus transfers risk of loss to the first lien mortgage holder after the lender has already underwritten and entered into a financing arrangement that facilitates the purchase or refinancing of a home. The lender has no knowledge and no say in the subsequent additional risk and potential decline in the value of their collateral. In a statement in 2014, FHA summarized the existence of these super priority liens increases the risk to taxpayers, losses to taxpayers. Fannie Mae and Freddie Mac, while operating in conservatorship, currently support the housing finance market by purchasing, guaranteeing, and securitizing single-family mortgages. One of the bedrock principles, and I would say this is a bedrock principle of both U.S. and English law for some time, is that mortgages supported by Fannie Mae and Freddie Mac must remain in a first lien position, meaning that they have first priority in receiving the proceeds from selling a house in foreclosure. As a result, any lien from a loan added after origination should not be able to jump in line ahead of a Fannie Mae or Freddie Mac mortgage to collect the proceeds of sale on a foreclosed property. In brief, enterprise programs and those of lenders, banks, savings and loans, credit unions, first of all, support the ability of a borrower to purchase a home. In other words, without owning a home, there's nothing to retrofit. A PACE loan is only available to someone, and this is part of the requirement of the legislative plan put forth by the PACE community, is only available to someone who owns a home. In the vast majority of those cases, that ownership is obtained by a mortgage loan in which a lender has placed hundreds of thousands of dollars at risk. Accordingly, Fannie Mae and Freddie Mac, when they purchase loans, require at all times that they remain in a first lien position. Also, I would note, and this is more of a little esoteric legal point, the congressional charters for the enterprises require that a borrower have at least 20% equity in a home or have an approved form of credit enhancement such as mortgage insurance. A PACE loan can erode and potentially partially or completely erode that 20% equity cushion. PACE programs are created to attract investors to provide funds for loans for energy retrofits. Unlike normal home improvement financing, the PACE program seeks to secure a first lien on property for a loan through a governmental tax lien. The financing proposition or concept, as they call it on Wall Street, is simple. If a residential property has to lose 90% of its value before a PACE lender incurs a loss, the investor has a very attractive investment opportunity. However, that opportunity comes at the expense of existing lien holders who unexpectedly bear a new risk of loss and in some instances to the disadvantage of consumers. PACE programs transfer risk. PACE programs fundamentally do not have comprehensive regulatory supervision. PACE programs have no required uniformity. PACE programs in many, but not all instances, are administered by third parties that don't follow the same consumer protection requirements applicable to residential mortgage lenders. FHFA Director Mel Watt has been clear. Super priority liens ahead of enterprise loans transfer undue risk, and only true second lien status avoids this problem. In other words, FHFA cannot sanction first lien status programs for enterprise participation. Court cases across the country, including in the Ninth Circuit here, have upheld the agency's directions to the companies on that point. Liens running with properties that are not extinguished through foreclosure are not true second liens, even if termed somehow subordinated, a term that has some lack of clarity around it. Let me add that this position would be true even if the enterprises were not in conservatorships, where taxpayers bear the risk of loss. But they are in conservatorships, and the conservator is bound by statute to preserve and conserve enterprise assets. Permitting a hidden or future lien to defeat or impair recourse to collateral. Let me repeat that. Liens which impair or defeat access to collateral, which is the basis for secured lending. A secured loan comes at a better rate than an unsecured loan. Has market implications. Now, FHFA is mindful of the interest of California and other states, and indeed itself agrees with promoting energy efficiency. FHFA supports enterprise activities that promote energy efficient improvements and favorable consumer lending, financing. To that end, I've provided an attachment to keep my statement shorter than it needed to be, which highlights what we've been doing as the conservator, telling them to look at this stuff. We have a duty to serve rule, which is for low and moderate income communities, other things, and what they're doing to support energy efficiency. These programs benefit from uniformity, from sound underwriting, and from a regulatory regime that oversees and examines the loan financings. To the chairs, vice chairs, and members of the committee, I hope this information has been helpful to you. I'm happy to answer any questions you may have.
Mr. Cooley.
Mr. Pollard, in general, I appreciate your explanation. And in this focus on collateral, it seems to me that in the last 15 or 20 years, GSEs have come under increasing scrutiny in the Congress just because of their potential to bring financial exposure to the federal budget generally. And GSEs sort of entered the lexicon because people started focusing upon them, the secondary market, the importation of risk, and the issues of scrutinizing your assets, not taking on undue risk. That seems to me to be the trend in the way the federal agencies, federal government has sort of looked at these enterprises. So the fact that our governor has over a span of years sort of been sending out notices, can we find a way to fix this, can we find a way to fix this, and yet the financial analysts have been saying, well, our analysis of these, the risk is not changing. It just seems to me that the advice we are getting sort of aligns with a larger conversation I've been seeing at the national level about possible risks to the federal treasury through the GSEs and needing to rein it in. It sort of seems to me that the response we've got on this PACE question actually aligns with a much larger conversation about prudence and care in the administration of the GSEs. Would you just comment on that?
Yeah. First of all, Governor Brown, and when he was Attorney General, communicated with us regarding energy retrofitting. He's long been an active supporter of that, so I think he's been consistent in that. Risk is like the first law of thermodynamics. You know, you can change matter, alter it all up, but you can't do away with it. And whenever someone lends money, there's some risk. Now, let me say this at the outset. It would be ironic for me to provide an attachment to my statement saying that Fannie and Freddie have energy programs and are actually increasing them to support lending that they can support, and somehow say that we shouldn't care about energy. And that's not our view. We support energy retrofitting of homes. The idea, though, of transferring risk to get investors is certainly makes sense. That's what most people do. Those investors bear that risk, and the lenders in a second lien position, for example, charge higher interest rates. And that's how they protect themselves. Their loan will be extinguished if there's a foreclosure. But if they've done good underwriting, full and robust underwriting, if the asset, the improvement actually does produce value, and it's all been done prudently, then I don't understand why a second lien position with an interest rate commensurate isn't acceptable. I haven't understood that from the start. So our position, yes, there's a broad discussion on risk, who bears it. Fannie and Freddie are $5.3 trillion, just two companies. They are not on the federal budget right now. They are private companies. They are still private companies. So we've been trying to find out what's the best method of getting people credit without disrupting mortgage-backed securities that you may hold yourselves in a mutual fund or your pension plan. I know I do. I can't own Fannie and Freddie stock, but I can own a mutual fund that might have some interest. So, yeah, it is a large debate. It is a huge debate, a troubling debate, by the way, for all involved, regulators, legislators, and everyone. It's difficult. And all of the three directors since conservatorship have all expressed the need for reform. I hope that answers your question.
Thank you.
Mr. Linder? There.
Thanks. I have a couple questions. The way you described this financing program is a huge perk to investors because it puts them automatically into first position. And one of the questions that I had was in regards to the 10%. You said counties can charge up to 10% in admin fees. Is that a standard practice, or is it all over the board? That's the
statutory provision. I'd note a lot of them charge less, to be fair. I mean, let me tell you, I've worked with the counties here in California. I'm not just showing up today. And I've heard from states across the country. They usually call us to figure out how do we implement these programs. The PACE law is very thin. The PACE law that was provided to the states was very thin. And there's been a lot of how do we implement this. So the 10% is the most they could charge.
Okay, the most they can charge. And how does that compare with, say, for instance, closing costs or points on a regular second equity line or something like that?
Well, regular seconds have actually fairly low closing costs because you've already got the first mortgage, which has, and they're making it up in there. They're just saying we're charging an interest rate. So actually, the fees and charges are not like getting a first mortgage.
Okay, and then the other question I have is you talk significantly about the transfer of risk to investors, and this being a program that minimizes
transfer of risk to us.
Oh no, I mean with these PACE programs, what it does is there's
trying to avoid too much risk to the investors.
Now, when you say that, is that the same thing as add additional risk to the homeowners? Does it go hand in hand, or how is the?
I think there's risk in all parts of a transaction involving a loan. Everybody's at risk. The lender, the investor on Wall Street's at risk. The homeowner's at risk that they'll lose their home. So I don't know. I'm not sure I can answer your question by it's one or the other. I want to be fair to everybody. Well, people running PACE programs today are at some risk. I mean.
Mr. Poehler, has PACE worked with the third-party PACE administrators to develop some underwriting standards, and has some of the steps that people have taken, like the lien subordination agreements that are in effect, does that change things for you at all?
The lien subordination, as best I get it, is basically a deferral and focused on. A true second lien extinguishes, as does the first mortgage at a foreclosure. And saying that it's in the second position and will subordinate any charges or whatever, the question to me is, where do those charges go? Do they go to the next homeowner? I would add, if I could, on your point, though, there's an element that has nothing to do with FHFA, which is what a willing purchaser will pay for a home with a loan on it, no matter who it comes from. And that's part of the risk that we have to bear as well. So the subordination, we have spoken to the companies about it, had phone calls from them recently.
And the legislation in Vermont, has that changed things?
No. The Vermont and some of the other states that had second liens were very low dollar programs. They weren't much on solar. Vermont, interestingly, ran their program through a community credit union, which picked up all the consumer protections rather than doing it themselves. But the only one of those programs that had some focus that we thought made some sense, even in the second lien category, was one that provided for consent by the lender.
And just so we don't lose the point, we're talking. I mean, we're looking at this in a holistic
I don't
way.
need to talk about the whole country.
Right. We don't need. And the issue that we're talking about, the risk and the loan. I think just to continue to balance that with the improvement and the asset that people get with that, and that goes on the home resale as well. I mean, there's improvements that
and I want
are
to
purchased
fair,
with that.
I want to be
risk
fair, Chair, that again, it goes back to not what people estimate values are, not what they estimate energy efficiency is. It's what they've been proven to be, and what a appraiser thinks they really are based on real market conditions, and then most importantly, what a homeowner views about what they're getting and what they're taking on. So there's risk.
But they can get these same energy improvements to their homes with a standard second mortgage, correct?
That's correct.
Okay, and then I think just to clarify, what I was trying to the question that I was trying to ask before was more specific to if there's additional risk to a lender that's got the financing from Freddie Mac. If there's additional risk to the lender,
Right.
wouldn't that risk also be to the homeowner if one of these PACE loans is taken out?
Oh, yeah. I think the fact that a PACE loan is in this first position and is a super lien, you're actually going to be getting to a much larger point, which I hate to bring up here, but I will, which is there's something called layering of debt. In the financial crisis, people would buy homes maxed out based on the asset value. Asset values are going up, we'll lend you money. What did they do next? They went out and borrowed more money to furnish the homes. So that's called layering from below. The fact that energy efficiency is viewed as a public policy by the state government and county governments, at the end of the day, it is still a loan. And someone is layering debt from, we'll call it the top. So I think it does have that effect both on the homeowner but also on the sale of the home.
I think it's important to note, too, on that point, and I have one quick question after that. There is no statute or regulation that prevents a homeowner from taking multiple super liens out. And I'm still confused and have not heard a good answer that if there's 3 or 4, you could take one out for AstroTurf in your backyard, you could do one for, insulation and a new HVAC unit, and you could do one for solar, and I guess you could do one for retrofitting in some areas. You could have 4 super liens on your house. None of these are going to be having any underwriting, no standards. We've already seen overzealous, unqualified, and really fraudulent contractors in a number of cases walking streets in our communities preying on seniors, selling these. You could see someone have 4 super liens on a house. I mean, this seems like when we had people taking not only a second mortgage out, but refinancing their house and using it as an ATM that led to the housing bubble. And so, we come out of that with Dodd-Frank. And I was a member of Congressman Brad Sherman's staff, and I know you know him well from the financial services community. And we saw all the new consumer protections that went into our financial services sector, all the new underwriting provisions, all the new consumer protections, all the firewalls and safety that's put in the mortgage industry, and basically any type of financial product that involved risk or lending. And now you have a situation where we all know the value of these energy efficiency products. We all know the value that has to our not only economy, but hopefully in terms of preserving our environment and our resources. But in terms of the underwriting standards that are non-existent, and in terms of the consumer protections that I think are probably weaker than any other type of financial product you can attach to your home, what are your feelings on the overall implications this is going to have on our housing market, and what consumer protections would you like to see in place besides the super lien?
Well, let me say the following. First, our agency's position is fundamentally on the first lien. I want to be clear about that. And in our discussions with the PACE community, which very nice folks working hard, many of the counties are trying to do good stuff, we tell them that's our focus. But I would note, and these will be sort of my observations, sort of questions I would have as a homeowner in Alexandria, Virginia, about what I've seen. And these consumer issues are not unique to California. As I said, there's no really qualitative underwriting standards, no uniform standards, no enforcement by government through exams, reporting, data, sanctions. I mean, who do you go to? These are large loans. It's tied to the property, so in a funny way, you don't even have to care about the homeowner. I mean, fundamentally, because you're just saying, I mean, even if the house burned down, you'd have property that you could sell and then get your money. As you noted, this asset-based lending was a problem of layering debt. I mean, I don't even know how we know. And there was one item I saw that gave me a little bit of concern in one of the publications. I won't cite who it's from. I don't want to do that. They may have updated their publication. But let me read you just one amount. Financed amounts won't appear on a credit report. No impact on the debt-to-income ratio. Now, let me quickly say, debt-to-income is one of many measures used should you make a loan. Loan-to-value of the house, just the history, some of those other things, bankruptcies, all those things. Debt-to-income is not necessarily the only or the best, but it is something people look to. So when I read this, I at first didn't believe it. I didn't know what it meant. Does it mean that because you're running it through the tax at the county, it doesn't go into the normal consumer reporting? Because then what are we doing? Somebody doesn't have that made part of their debt-to-income ratio, and they go out to furnish their home. No foreclosure. Just go out to furnish their home. That lender doesn't know, apparently, that this person has an additional amount of money, which might move them from 43 to 44 to 45, 46% debt-to-income ratio. I hate to digress and note, when I was younger, my dad taught me it was 25%, but we've obviously had new times. That was rather a surprising one. So let me go. The public policy that everyone enunciates, and by the way, we feel strongly that retrofitting is a good thing. If that's the case, then I would ask this first question. Why is there a disclaimer? When you read the materials, I read in all the materials in PACE about this is going to save you energy efficiency, all this stuff. And then I read the following quote. We do not warrant the efficiency or production capability of equipment. There is no representation, no responsibility regarding equipment, its installation, including quality, cost savings, efficiency, or compliance of equipment with laws, codes, and so on. You have a public policy that says counties should do this because it's in the public interest. If someone is disclaiming that that will happen, I don't particularly understand that fundamental point. Standards, I don't know. I would be asking what an appraiser actually knows today. My discussions with the appraisal industry is not very rewarding in terms of where they are. They don't have enough sales. They're not comfortable yet. Some places they appraise properties, the enhancement at zero. And others they say, well, it's whatever it costs. Another question about these programs are how much do they actually tell you about what you're paying? You're paying 10% to the county, or up to, let's say 5%, just to be fair. Paying 5% to the county. Then there are administrative fees. And there's a bunch of small charges, little charges here and there. And then the one that I guess has always been there is they encourage people to finance that 10% or 5% to the counties. So they're increasing the debt. I mean, when you come to buy a house, you are supposed to put down 20% somehow. Save your money, do all of that stuff. Now, certain people in society who don't have the same strength, we have other programs. There's 97, FHA.
Mr. Pillar, I want to make sure members don't have any more questions to ask. We appreciate your opinion.
Okay. Well, then I'll just stop there. That's fine.
Okay.
That question.
Because we still have two more panels, and so.
I'm sorry to interrupt.
Well, no, that's perfectly fine. Yeah. I just want to make sure nobody else had any questions, and we appreciate you coming out from to visit us here in California. Now, next we're going to have the implementation part, and so that's important as well from the local levels. Okay. Any final remarks, Mr. DeBobby?
If you have any additional questions, you can certainly submit them to me in writing, and I'll be happy to respond.
Thank you very much.
This was a very difficult day for you. Thank you for being here today, and we appreciate your expertise.
Thank you very much.
Okay, that'd be great.
Okay. So next up, the actual, and I'm also interested in the question of that Mr. Pollard raised about the layering.
Can I offer an apology to the folks that are following me? I've met with many of them before, and I apologize not being here to listen to their presentations, but I'm going to try and deal with getting the pharmacy to get me some medicine.
Thank you. No worries.
I do apologize to all.
Thank you.
Okay. So, and I'd be interested in hearing from the local government folks about, because I'm thinking you all have your own policies on the ability of people to get multiple PACE loans and layer them on. And so next up, the implementation at the local government level. Again, another key aspect of this program. We have Jane Elias, Program Manager for Sonoma County. We have Jeannie Windeshausen, Placer County Treasurer and Tax Collector. Barbara Spooner from the Director of Energy and Environmental Programs, Western Riverside Council of Governments. Jane Hamill, Managing Director of California State Community Development Authority, and Dan Merzwa, Treasurer, Tax Collector, I probably said that wrong, Yuba County.
Perfect. Thank you.
Okay. Each of you about 5 minutes, and then provide time for questions.
Thank you, Chair Eggman, Chair DeBobney, and committee members. My name is Jane Elias. I'm the Program Manager for the Sonoma County Energy Independence Program. We began our program in March of 2009 as residential and commercial PACE, and very successfully, and it was done to mitigate our climate greenhouse gas emission reductions goals that we had set, which were pretty aggressive. In 2013, however, we looked at the opportunity to create what we call the Sonoma PACE Marketplace, and opening that up for other third-party PACE providers to operate within the county alongside of our Sonoma County Energy Independence Program, or SCIPE. Bad acronym, but we did a request for information along with that in 2013, and we selected, we had 4 respondents from that request for information. And then in October of 2014, we opened up that marketplace. One of the, to operate alongside our SCIPE product. As a condition of the marketplace, however, we did require that those operators sign a collaborative services agreement with the county. And the intent of that agreement was to establish certain criteria that ensured program standards and protections were in place. The agreement also allowed for oversight of standards and those protections. And I'll direct you to the handout that we gave you of the PowerPoint slides. The goals and benefits that we identified as far as opening up this marketplace was, number one, we wanted to expand the funding capacity. We only have so much capacity within the SCIPE product, and we wanted to ensure that PACE stayed operating and a viable financing option for people. We also wanted to provide consumer choice and let the consumers have the option to look at the other PACE providers and shop the product. And you'll see on one of the slides, slide 7, I believe it is, that we have what we call a click and compare tool on our website where people can shop that product and enter in an assessment amount and their address. In addition, we wanted to, and like I had mentioned, this was to reduce greenhouse gas emission goals. As a subset, and a big advantage of that was it also created jobs. And like I mentioned, an opening in 2009, this was during part of the worst recession we've ever had. We were able to keep contractors in a job and, in fact, hire additional people to work during that time. We also wanted to increase the program momentum and sustain the growth of that contractor community and facilitate the efforts to consolidate and capture the data from the other PACE providers to be able to roll up all of those greenhouse gas emissions and energy and water savings to report out to the municipal jurisdictions. Like I mentioned, about the climate action goals, we had set some pretty aggressive ones back in 2006. And when we identified the building sector of what kind of retrofits we needed to do, we pretty much estimated it needed to be about $2 billion worth of retrofits that need to happen on those buildings. one of the questions was, how does our model differ from others? And the Skype product is a municipal product. We own, operate, fund, and invest in Skype. It is administered by our auditor, controller, treasurer, tax collector, and then it's contracted through our General Services, Energy, and Sustainability Division. The combination of that staff brings together a large amount of expertise, not only in financing, bonding, land-based financing, but in addition, we have expertise in building trades, building energy codes, solar, water, and green building. We are considered one of the marketplace members alongside the other providers and within Sonoma County. And just to be clear, Sonoma County does not administer or operate. We don't provide financing, and we don't get any funding from any of these other providers. In just this last month, our board directed staff to pilot a local PACE oversight mechanism to continue to participate in the statewide efforts to develop PACE financing marketplace consumer protection policies and develop a new Sonoma County 2.0 solicitation process based on those best practices that are identified. So this pilot compliance oversight program will be implemented collaboratively with the other PACE providers that are not only in the marketplace, but also non-marketplace members. And what we will do is solicit the participants' best practices, collaboratively develop the mechanisms and forums for monitoring and improving the ongoing marketplace performance, and then we will collectively review and monitor that compliance. We hope that having this local marketplace compliance oversight pilot program may help inform the structure of anticipated state program oversight. I wanted to also mention and direct you to some of the numbers that we have listed on slide 3 of the presentation. We have there our tax delinquency rate, and this goes to some of the prior conversations that have happened earlier today. Our tax delinquency rate within Sonoma County is 0.34% for those properties that have Skype assessments on them. And in comparing that to...
4.3.
Pardon?
0.3 or 3.4?
0.34%. 0.34%. Compared that to the normal tax delinquency rate within Sonoma County is 0.87, and an overall 10-year tax delinquency rate of 2.38. So I just wanted to note and highlight that, and also the fact that there have been 0 defaults. Obviously, property owners who are using PACE in Sonoma County are doing so to improve their homes and are wanting to make them healthy, energy efficient, save money, and they want to stay in those homes, and they pay their bills. The consumer protections that we have in place for the program for Skype are numerous, and part of the Marketplace Collaborative Services Agreement carries over some of those consumer protections, and I've highlighted those as well on some of the other slides. On, let's see, further down in the presentation, you'll see on the slide 12 about the PACE Marketplace pilot, but also on slide 6, one of the things about the collaborative model of the PACE Marketplace is because we do have our Skype product and we have our Energy Independence Office operating with this expertise, we work collaboratively with the other PACE providers that are operating to help do co-branding, co-marketing of PACE. We've got the consumer protections. We do have some of the oversight ability. And consumers can contact our office to ask questions. So we're very proud of what we've done with PACE within the community. We certainly hope that looking at some of what we have in place will be considered further down the line with some of these consumer protections. And I just wanted to highlight real quickly before I hand it over, I hope I still have enough time, our application process. When a property owner is interested in PACE, they provide that information to us, and we independently verify the underwriting criteria that's provided by the information that's included on a required title report. We also verify the property tax records, bankruptcy court records, and other data. We don't rely on property owner certifications to meet that underwriting criteria. We have the applicant assigned to a file manager the entire time from beginning to end and even afterwards. And we do require that they return in a bid or proposal with each of those applications that has the cost of what those improvements are going to be. And if that cost exceeds our unit max cost, we go back and we ask for justification as to why that is. And at times we have denied them. So those unit max costs are evaluated regularly and are determined through industry sources and prior funded projects. We also require that permits be pulled for all improvements, and before that project is dispersed, we verify to make sure that those permits have been completed and finalized. And we're also, like I had mentioned, we're a resource. We work one-on-one with the property owner throughout the whole process, including we have them sign contracts in-house for nearly 100% of the projects are done in-house, where we have a complimentary notary services for that contract signing, and we have the opportunity to further answer additional questions with them in person at that point. As a result, we have had very few complaints due to the level of the communication and the customer service provided by the property owners throughout the process. And we hope that in our pilot project of 2.0 and the open solicitation project that will come out of those best practices for the marketplace, that will be the same result that will continue forward. Thank you for your time.